What's up, guys, and welcome to the Fit to Flourish podcast. Today, I wanted to talk real quickly about how to enter and exit trades. So, this is probably the most requested topic that I get when it comes to trading. A lot of people are like, well, I want to trade, but I don't know when to get in and I don't know when to get out. So, this ebook that I put together for you makes it extremely simple on when to get in and when to get out. The main thing that you want to remember is you want to get in and get out at key levels. Key levels or areas of support and areas of resistance, depending on whether you want to go short, which means you think on selling, you think the stock's going down, or if you want to go long, which means you think that the stock's going to be going up. Okay, so let's get right into it. So, Fit to Flourish, that's the boy. 4 rules to a perfect trade. So, entering your trade, you want to enter in multiples of 3. So, stock equities, your shares, futures, derivatives, options, contracts. Okay, enter in multiples of 3. Here's why. If you're shorting, you're going to be entering one tick below the bar, the signal bar. If you are longing, you're going to enter one tick above a breakout bar. Contracts or multiples of 3. Remember that. You're going to set and picture your stop loss. Okay, so you're going to set a stop loss that is one tick below your signal bar. Now, a lot of people might be like, okay, well, I get it. You're telling me to do this, but what does that actually look like? So let me actually move to this tab here. We're going to clear everything out so we can actually see what that looks like. So let's say that you're going to go long, and this is the bar that tells you, oh, I should probably get in. So this is a pretty big bullish bar. Okay, this is our reference bar. So what we would be doing is we would be getting in one tick after that forms. So a tick is just a price movement. So one movement in price. Okay, one increment in price. So we would get in one tick above this bullish bar. That would be our entry. Now our stop loss is set one tick below the open of this candle, which is right over here. So one tick below where this line I drew is. Okay. And then, like I said, you're setting that stop loss one tick below your signal bar. If your play starts going the opposite direction, this is where you want to definitely exit. So if we go back to this picture we got in right here, if this starts to move down, if we start to move down and we hit this line, then this is probably going to go in the opposite direction. Okay, so that's why we keep that as our stop loss. If we hit that line, you got to get out of the trade. It's probably going the other way. So if your play starts going the opposite way, you want to definitely exit at that area. Do not have leeway. So for example, oh, well, it hit my stop loss level, but I want to see if it'll go back up. No, we don't do that. Never have leeway. Respect your stop. Good trades, just go. So again, this is an example. So you're entering one tick above to go long, but if it starts to go the opposite way, this is your stop loss. Your stop loss is that line. Now, time frame. So if you're day trading, most people trade only on the 5-minute time frame. This is the optimal time frame. I'm telling you, you could back test, forward test, do whatever you want to a ton of trades. This is the best time frame. Now, if you're looking to swing a little bit longer, then you might want to look at the 15 or 30-minute time frame, but the 5-minute time frame is pretty optimal for catching a lot of the smaller moves as well as capturing some of the bigger moves that you might see intraday. So you always want to trade with trend as well. So use this time frame and then trade with trend. The trend is your friend. So if the trend shows that it's mostly going up, then you want to be looking to go long. If it shows it's mostly going down, you want to be looking to short. And then this is what the 5-minute time frame or the time frames look like on TradingView. Now, this is why we get multiples of 3 with our contracts, shares, equity, whatever it is, okay? So you have a multiple of 3 contracts or shares. You take 1/3 out after you go 3 ticks in the direction of your trade. So after 3 ticks go in the direction of your trade, then you take one contract out. Now, what does that look like? Let's go back to this tab here. So let's say we entered here, and then we get price movement. We get one move to the upside, we get another move up, and then another move up. So on this third move up, price went up enough that we made some money. After this third tick up, we can take off one contract. So we're collecting that profit from the one contract. So that's all that we're doing there. Then the second contract or share, the 2 out of 3 come out after an additional 3 ticks or when your target is reached. At this point, you need to move your stop loss to your entry point. Okay, so what does that look like as well? So an additional 3 ticks would be something like, okay, we're still moving up another 1, 2, and then maybe we move up to 3 here. Now you can take out your second contract. So we took out 1 here, 1 of 3, and then we took out 2 of 3 here. Okay, and then the second one can come out either there, or it can come out if, let's say, you had a target of all the way up here. You could take the second one out when you hit your target. Okay, and then once we do that, once we take out that second contract, what you want to do is you want to move your stop loss. Our original stop loss was over here. Now you want to move this stop loss to where the entry was, because since we're moving up and we're making money, if this starts to come back down, we don't want to lose money all the way back to this previous stop loss. We want to move our stop losses up as price is moving up. Keep us in the profit. So we're moving our stop loss up now to our original entry. Now the third portion, or the third share or stock that is still in play, this is your risk-free opportunity. This is your runner, so to speak. So you let it run, and it's considered a risk-free opportunity. So once we hit our target, so let's say that this was our target, this level right here. Let me go back to this tab here. So let's say we hit our target. This was our target. This level right here. Let's make it an orange line. So this line was our target. And we hit it. Now we made money. Now the third contract, we're just going to let it go. We're going to see how far it can go. So your third out of third contract or share is a risk-free opportunity. Why? Because we already made so much money from this first and the second contract that this last contract, we're just going to let it run. It may hit 1,000% or it may come back down. So at that point, you can pretty much put your stop on this last one wherever you'd like. Me personally, I like to put my stop where my target was. So if we hit my target and we're still going to the upside, if it starts to come back down and it hits my original target, I'm just going to take it out there because I'm still in profit. But you can do whatever you like with it. A lot of the times that last one will just go to like 1,000%, and then you can post that 1,000% gain. But you can pretty much do what you want with it because it's a risk-free opportunity. So that concludes it for the how to get in and how to get out of trades. A lot of the times when you're looking at trades, when you're exiting, people also ask me this, is what you want to do when you're exiting trades is you want to look to the left and you want to say, what was the previous high? What was the last previous high? So let's say you get in on a trade here. We're looking to go long, to go up. So when do I get out? Well, look to the left and see where your previous highs were. or previous areas of like resistance or consolidation. But you pretty much want to look to the left and see, where was there trouble previously? Where did we stop previously? And you can see that we'll actually hit those levels. Okay. So that's just a basic overview of, hey, how do we get in trades? How do we exit trades? And then also be looking for key levels. So any questions, drop them in the comments. Very simple overview of how to get in, how to get out of trades. It's your boy, Mr. Fit to Flourish. Thanks for tuning in, and I'm out. Good morning, welcome to the Fit to Flourish podcast. Let's talk wellness, finance, and growth.